Hey everyone, welcome back to the channel. Today we're going to take a quick look at Tesla. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. I've heard a lot about Tesla lately and how Elon is killing the company. I wasn't sure if this was true or just noise, so I decided to build out a quick model and see what the financials are telling me. The first thing I did was pull their deliveries and production numbers, which are actually very impressive over the last 5 years, which kind of surprised me based off the narratives I'm hearing. They've ramped up from delivering just around 250,000 cars in 2018 all the way to 1.8 million in 2023. There was even a huge jump from 2022 to 2023 where deliveries grew by almost 500,000. I was not expecting to see this based on the narratives I've been hearing online. The only big issue I see is actually at the start of 2024. Their deliveries are down by about 50,000 units year over year versus Q1 of 2023. They came in at just under 380,000 in Q1 this year versus 425,000. So that is a bad sign from a year over year perspective. One other thing that popped out to me when looking at their financials is their inventories are growing. They ended 2023 at 13 billion and after Q1 they were up to 16 billion. They're building more cars than they can sell. We saw a big jump happen back in 2021 to 2022 as well, from about 6 billion to 13 billion. I'd guess this has to be due to kind of overproduction from a slip in demand as we exited the pandemic, but honestly, I didn't take the time to really dig into that. It's just an alarming trend to keep note of, especially as future quarters are announced and released. So now onto my model. I'm modeling the revenue the same way they do in their income statement. So they have automotive sales, regulatory credits, leasing, energy generation and storage, and services and other. Historical trends look very good for all of these from a growth perspective. However, Q1 of 2024 actually tells a very different story than what we've seen historically. We see automotive sales is actually down 13%, regulatory credits is down 15%, leasing is down 16%, and energy generation is growing at 7%, and then services is growing at 25%. I've used these as a basis for my 2024 growth. For the business units that are declining, I actually assume they will reduce the rate of sales decline by half. So for automotive sales, this means 6.5% decrease year over year compared to the 13% they've shown in Q1. So I'm assuming they're actually going to have to reduce costs of their vehicles to actually sell more, and that's how they're going to reduce the sales slip. So I do actually have all the businesses though turning around to modest growth after a couple bad years. By 2026, I have everything growing again from a top line perspective. I think this is optimistic, as in Q1 24, their EV market share actually dropped 10% for new deliveries, so there's a lot of competition. The reality is they may have more than just a few bad years, but for this model, I'm trying to be optimistic for them. So for my model to work though, I am assuming that if they're going to sell more cars, they're going to have to reduce the price of these cars. This will directly impact their margins, so I have slight increases to COGS as a percentage of revenue over the next few years. With all of these factors at the business unit level, let's take a look at how they roll up in aggregate. I'm modeling a 3% decline in revenue this year, then a return to growth at 1% by 2025, and then slowly ramping back up to 11%. But to feel this, we can see COGS as a percentage of sales is increasing from 82% in 2023 to 86% in 2033. This seems reasonable as there is a lot of competitors and a lot of them operate at a 10 to 15% gross margin, and this would put them in line with that. I've held SG&A and R&D flat, and same with their capital expenditures, just to keep things simple, as this was just kind of a preliminary analysis. With all these assumptions, revenues go from just under 100 billion to just over 200 billion in a decade. With cash flows, they actually do drop as we do see gross margins shrinking due to pressures from competitors. So this gets us a valuation between 62 billion and 107 billion, just depending on the discount rate and perpetuity growth. I thought this was actually a fairly generous model with pretty good growth on the revenue side. However, revenue appears to be priced with hypergrowth and impressive gross margins, which I just don't think is the reality anymore. With consumers shifting away from Tesla and their strategy relying on price drops to boost their sales, I think it's going to be hard to maintain those 25% gross margins that they saw historically. This year will be pivotal, I think, to how the market views Tesla. If they continue to lose market share and have a Reduced gross margin. I think Wall Street could actually read the writing on the wall here, and we could finally see a big dump from Tesla stock. I know they have historically had a very loyal shareholder base, but at some point you're going to see the growth is gone and that the costs are rising and the economics just don't make sense anymore. And I think that, if they can't turn things around this year, it could be the year. Anyways, this was just a quick one. I hope you enjoyed it and found it interesting. Leave any questions or comments below, and thanks so much for watching.